to the Capital Discussions Roundtable. I'm Tom Nunemaker, and today we have our special guest, Himanshu Raval. And we've known Himanshu for quite a while, especially most of the people on the call. But before we get started, just a quick disclaimer, the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors, such as liquidity, slippage, and commissions. And this disclaimer is at the bottom of all of our web pages if you care to read it in its entirety. So with that, let me do one more quick check for Jim. And he hasn't made it, so I will pass the ball to you, Himanshu, and why don't you, for the people that don't know you, maybe explain, who you are, your training background, and, basically why you're here.
Okay. Well, some of you already know me, in which case I offer you my condolences. Quite a few of you do not know me, but now that you are here, you do know me, and I offer you my condolences as well. My name is Himanshu. I do not call myself the calendar king, but John Sarkett in one of his stocks and commodities articles did mention my name and gave me that nickname. Hence it is here. I have been trading mainly calendars since the year 2000, and essentially even today it is my bread and butter trade. While I'm familiar with all the other trades as well, I generally personally prefer calendars because it is a debit trade. I can be directional, non-directional, and many other things, as I will explain as we go beyond. I'm also available anytime. A lot of people just call me out of the blue, quite a few whom I've never heard of before. They send me emails or give me a call asking me questions. So should you be interested or have any more questions, feel free to do the same. I will give you my email address later. So since I cannot see the chat window.
I can keep an eye on it for you.
Okay.
Sorry I'm late.
All right, Jim is here. All right, so let's proceed. Now, what exactly are calendars? Most of you probably know what calendars are, but for those of you who do not know what calendars are, we essentially sell the front month options and we buy back the next month or the month beyond or way beyond at the same strike, and that essentially is a calendar.
Himanshu, are you sharing your desktop?
I thought I was. Hold on. Am I not?
No.
No, I don't see it.
Oh, sorry.
No problem.
Okay, here we go. Now can you see it?
Coming up. Got it.
There it is.
Okay. Time seems to go into the slideshow mode. Okay. Okay, doesn't matter. Fine. So these are the calendars. Let me go to the next one. Next slide. Okay.
Can you just maximize? Can you maximize the screen just to make it a little bit easier for everybody to read?
Okay, is that better?
Thank you.
All right. Very good. So, as I was saying, calendar, oh, what is this? Somebody sent me a mail. I should keep them away. All right. They are also known as time spreads. Like quite a few income trades or most income trades, we have a positive theta. One great thing about calendars is that usually it always has a positive vega as well. Calendars are also a proxy for buying vols. We buy the low vols and sell into high vols. We usually have a positive weighted vega, which is much better than just positive vega all by itself. As we go deeper into calendars down the line, we will learn more about what weighted Vega really is. So let me go to the next one. Why trade calendars? Number one, I like to trade calendars is because it is a very forgiving trade strategy. You don't really have to run around too much, and you don't get hurt too much as well as you can in iron condors and iron butterflies if you are not sitting in front of your machine. As I said before, it has positive theta. I find that it is a much lower maintenance trades. Can be used as a hedge in varying degrees. Again, we will look at that as we go further down into discussing what calendars are and how we set them up. They can be used as stock replacement strategy. So, if you really don't want to buy 10,000 shares of something, you can still use calendars and sort of have a proxy position on, which is where you are controlling 10,000 shares or more if you want. Another reason for calendars that I like is that we can set them up to be either bullish or bearish. We can also, of course, set them up to be market neutral as well. Now, this one is a good one. It is much easier to manage in a very fast market. If the SPX or the RAT or NDX is dropping like a rock or shooting up like a rocket, it is much easier to actually get your position back under the tent than it is in some other four-legged trades. It is very flexible. It can be morphed into other structures like diagonals and double diagonals. And we do get easier fills even if we are legging in. In fact, in some cases, we get much better fills if we leg in. That also we will talk later as we look at various ways of putting the calendars on. So let me show you what it looks like. This is a single calendar where we are selling the March 1200 call and we are buying the April 1200 call. It's just a very simple single calendar. I'm going to go ahead and show you a double calendar where you can go, 20, 30 points above the current market and put on a call calendar at 1230 in this case, with the RUT being at around 1200 or 1195 something, and go down to 1160 and put on a put calendar, and together it would be called a double calendar, and we would manage it as a double calendar as opposed to two separate single calendars. Let me show you some of the results that I've had over the last year. These are regular calendars that normally start anywhere between 30 to 50 days out from expiration. And then I have something here called the wealth calendar. The wealth calendar is something that I dubbed where my short calls or puts are about 2.5 months out, and the long calls are the next month or the month after that. And these are typical results that you can get from slightly directional calendars. These are what you get typically from, well, actually, I might have the next one. Hold on, let me show you. Yeah, here we go. These are the typical results that we get from normal weekly calendars where you are selling the next week and buying the next month. Most of these trades will usually last about 1, 2, at the most 3 days, sometimes 4 days, but you put them on by Monday or Tuesday and you are out by Friday or next month. This is essentially the part of my slides that I wanted to talk about. The rest I'm going to talk about are my live trades that are currently on so that you can have a good idea of what to look for when you yourself are trading calendars. By the way, are there any questions? As I said before, I'm not looking at the chat. I don't even see
Nothing yet, Himanshu. No, okay. Nothing yet.
Very good. So I am going to minimize this, and I'm going to bring this up. So here is OptionNet Explorer, which is what I use sometimes to manage my trades. I know some of you use this, some of you use OptionView. Most of you probably use Thinkorswim, which is probably as good. But here we go. This is a rut. I actually rolled this over literally about an hour ago. And we have been in the trade for 2 days, and we are at 12.51%. I put on this trade at the 12.10 strike when the rut was at 12.03. It actually went down the first day, then it came back up. Today it actually went beyond my short strike, and I went ahead and rolled it over to the week after next. In this case, I sold the front week, and what I did was I bought the March monthly call. In this case, of course, the Feb was also a monthly, but it was only a week away. So this is a single calendar, and these are the sort of returns that you can get. Let me show you something else here.
Before you go on, while you set up the next trade, there was a question about do you find the Greeks on OptionNet Explorer meet your needs, or would you rather end up using OptionView? If I may, Himanshu, add to this, but the challenge, okay, with Thinkorswim and OptionNet Explorer basically uses all of the Greeks directly from Thinkorswim, and what they end up using is that they use single IV pricing. Where that becomes a challenge is that when you look further below or into the money or further away from the money, so as we call it, the put skew and the put call parity. When I look at something, let's say a 20 delta put, and I look at the call versus the same strike call versus the same strike put, or if I look at them at the money, that difference is where they end up having their biggest issue, especially in the indexes. And why I say especially in the indexes is because the indexes don't pay dividends. Like the SPX or the RUT don't pay a dividend. It's actually calculated to automatically be reinvested. So they have a very, their biggest issue is with same month, okay, skew. Okay, difference between one strike and another. Since Himanshu is using calendars, the same strike in different months, they basically have made the same mistake, the same amount, okay, just in different time. So the skew or the Greeks won't be as far off in calendars, okay, in OptionNet Explorer or in one than they would end up being in OptionView. Having said that, if you built all of your trading strategies around one set of Greeks, the way Thinkorswim ends up calculating them, you could actually have your rules set up so that you make your adjustments off of the Thinkorswim or OptionNet Explorer Greeks and not have to worry if they were calculated slightly off or not. So to answer, at least from my perspective here, as long as Himanshu has used a consistent set of Greeks, I don't think it would make any difference to him. Himanshu, have you done any work in between taking a look at what the Greeks are on one or Thinkorswim and taking a look at a different tool called OptionView?
Not really, no. I started actually trading options long before I even knew that tools like OptionView and OptionNet Explorer existed. So I was literally just going by, in fact, when I first started trading, I was trading on interactive brokers, and I just looked at the deltas, all the Greeks that they showed me themselves, meaning the IB guys. So if the IB guy said that your position delta is a total of +8, then I would say, okay, it's +8.
Yeah. The other thing that I think is very important, and we've talked about this, Himanshu and I have known one another for what, maybe about 4 or 5 years at this point, is that what's really most important is understanding how the T+0 line, right, in either tool, how the current P&L looks, and how that's going to morph into the expiration graph when you move down, you move up, vols move up, and vols move down. So understanding how that ends up changing is what's most important, which kind of ends up leading right to the next question, Himanshu, which is, can you then describing the RUT trade, what strikes did you choose and how it's showing, okay, profit when vols drop?
Yes, in fact, that's where I was going when suddenly one said that it could not connect to the Thinkorswim feed for some strange reason. Okay, here you go. Now maybe it will come up. God, it's real slow today.
Yeah, you're the first one that's ever had problems with Thinkorswim. I'm sorry, sometimes I'm too cynical for my own good.
Okay, so Rahul suggested to show this trade from day one. So let's go to, which is on 210. Today is 212, so I will just go to the selected date. Okay, so around whatever time it was, 15:55. No, it can be 15:55. But usually I place my trades around between 3 and 4, so it might be. So here we go. I selected the 12.10 strike. The current price is 12.03. It was moving up, so I thought it could continue to move up, which actually it did, thank God. And I placed my trade at the 12.10 strike. I usually don't like the strikes ending in 5, so that's why I did 12.10. And then the next day, which was yesterday, right, Wednesday. Let's see. Yesterday, it had already moved up around 6.6%, even though it went down a little, but that was okay. And then we came to today, and actually I should have said, so when did I actually rolled it over today at around 3:30, 3:45-ish. Let me see what time I rolled it. I rolled it at 3:24 p.m. And SW wants to know, okay, so here is I just described the trade. It was the front week, I shorted the 12.10 call, and I bought the March monthly 12.10 call. So those are the strikes that I chose, and now you also want to see how it is showing a profit when vols dropped. Vols dropped.
Vols did drop during this trade, right? I mean, we've sold off the last couple of days in terms of the VIX and the RVX.
Well, it dropped, it may have dropped, well, I put the trade on literally day 0, nothing much happened. On day 1, the market actually went down a little bit. So the vols probably went up. And then today, the vols did drop. But as you can see, this is how I'm doing. Because remember, in the very short term, my delta literally works a whole lot faster than the Vega. I'm not really sure if that is true, but that is what I have observed. And because my delta was positive, as the price moved up to my strikes, remember in a calendar, when the prices move towards the calendar, you make money. So
right.
if you have
what makes that trade, I think, make so much money so quickly is that if you put this on after the vols, after the market has pulled back a little bit, there was some fear in the market, and the vols moved up. Usually what happens is that front month, okay, the closer to expiration in terms of days to expiration, will end up moving up quicker than the back month. We know that because when we've looked at like the VIX futures, okay, you see them going in contango and during periods of time, the fear level ends up really taking the front month up higher. So what Himanshu will end up doing is that he could either be watching the vols at each and every strike and being able to do this, or he can end up just knowing, hey, at this point in time, if I'm going to end up selling the whatever it was, the 1 week and buying the 1 month, okay, that this is how much how much the calendar should end up costing me. And he'll know when to end up buying them more cheaply. Now, the challenge with that is that you really, really if you're going to end up using the pricing like that, if you're not going to build your own volatility model and Excel spreadsheets and all this stuff, you have to end up really, really knowing your underlying and being able to end up seeing that. And, you know, when I ended up meeting Himanshu, at that time, back 5 years ago, he was trading IBM calendars every single month. This was before there were weeklies. Every single month in, month out. And, you know, we'd have the conversation, Himanshu, you know, how much would a calendar cost if? And you could give him like any type of scenario, and he knew what the pricing would end up being. Okay, so he knew when he was buying things at a very good price. So what ends up happening here, he knows that if volatility has gone up a little bit, okay, and the front month volatility has moved up more than the back month, he knows that those above the money calendars are going to be rather cheap because the IV is a little bit more elevated in the front month. So if the market does move up and the volatility, especially in the front month, comes down more than the back month, even though a lot of people think of Vega as a positive Vega trade, and they're like, wait a second, how did you end up making money, okay, if this went up and Vega and volatility came down, if you were a positive or a long Vega trade, and Vega and the VIX went down or the RVX went down, how'd you make money? That's what he said, when sometimes weighted Vega is better. If you're selling that higher, okay, implied volatility, because it's moved up in the front month versus the back month, when it comes back into line, if the market bounces back up, it's like you're making money in both directions. You're making money both on your delta and on your Vega. So in some ways, you know, I take a look at the trade that he put on when he put on it. It was basically, you know, direction-wise, I'd say he has a 50-50 chance. However, okay, if he makes money, he's probably going to end up making $1.50, and if he loses money, he's only going to lose $1. So he's got a positive expected return, okay, even if he's a 50-50 guesser on which direction he ends up going. Now, I happen to know that I've seen some of his technical stuff, and I know he's better than a 50-50 guesser on which way the market ends up going. But it's really about setting your risk rewards properly.
That was beautifully explained. A whole lot better than I could have. But SV, did that answer your question?
Yes.
Okay.
Some of the other questions, if you want me to end up reading them into you, do you like to see a certain percentage difference between the vols, okay, between the front and the back month when you end up putting them on? Obviously, Cheryl, that question would be different depending on whether he's looking at weekly, regular, or wealth calendars.
Correct, yes. In a weekly, usually in a weekly, the price movement is what really matters. Most of the times, by the middle of the week, you know, unless Ms. Yellen is going to speak or some real big financial reports are going to come out, usually by the middle of the week, things have settled down. So when we started this trade, our IV for the front week was only 1560, and our IV for the back month was 1718. So there was a less than 2-point negative skew. So, and therefore it is generally acceptable to put a trade on. If the skew is like -3, -4, something like that, then I probably would not place the trade. Wait until the timing is right. Next day, here it goes to 1611. So we lost some money here. Actually, we didn't, because the price is still 850. So we are still up by 5 cents here on day one. Whereas over here, it went from 1760 to 1780. So the vols increased here. So the price of this moved up by 90 cents, and the price of this moved down by 5 cents. So we just made 95 cents in one day on, per calendar, per contract, I should say. And then we go on to the next day. Today, the prices moved down. Sorry, the prices moved up, but the vols moved down. And therefore, there was a more than a usual. Now it's dropped down to 1247 from 15, but that's when I rolled it over to a 14.09. And when I rolled, my original margin was $4,221. After the roll, I netted enough cash that my margin actually went down to 28.17.
So SV ended up asking, okay, were you just lucky because it ended moving in your direction? And SV, that's exactly the point that I was making before. Was he lucky that it moved in his direction? He would say no because he did his technical analysis, he did his homework. I would say yeah because it's a 50-50, guess on which way it's going. But where he's not lucky was that the way he set up his risk-reward ratio was even if he had a 50-50 chance, it was, hey, if I'm wrong, I'm going to end up losing $1. If I'm right, I'm going to end up making $1.50. Okay, because of the way the vols were set up, he was able to end up setting up that risk reward. So I think it's a combination of good technical analysis, playing some directional stuff, but in the long run, it's really about setting up better risk reward ratios with better expected returns.
That is correct. Though I agree with you that I would say that initially, yes, technicals would be 50-50, but then as you keep on doing the same things over and over again and you sort of hone your skills, you can skew yourself slightly more to the positive side.
Okay. Raul asked if I could end up explaining that again, okay, to go a little bit slower. Okay. Himanshu, if you'd end up taking up the vols and showing, basically what Himanshu is always looking at, okay, because he and I have had this conversation, is that he'll look at the implied volatility of the front month that he's selling and of the back month that he's buying. Now, normally, let's say he knows that when he's doing this trade, he's going to end up giving up. Well, Himanshu, let me ask you, when you're looking at this specific trade, how many vol points are you willing to end up giving? What's the average, and what would you be willing to put the trade on at?
The skews between
the vol. Like, what would you buy? Like you ended up showing. If you end up showing this, if the front month implied volatility is, let's say, at 10, and the back month is at 11, you have a 1 point difference or a 10% difference.
If the skew is less than or greater than -2. And if it is positive, then of course it is greater than -2. But as long as the skew is greater than -2, I will put a trade on.
Okay, so everybody, you understand what because when he and I talk, we talk like traders that have been doing this for a long time, because we have, which means that if the front month that he's selling is, let's say, a 10 vol, and the back month that he's buying is a 11.5 vol. The difference is he's paying an extra 1.5% in vol, meaning he's buying an 11.5 and he's selling a 10. Now, a lot of people might say, well, isn't that bad? He's buying a higher vol. Well, he's traded this product so long to know that as long as there's not a 2-point difference, there's only a 1.5-point difference, when he can buy that at less than a 2-point difference, he knows that because of the front month is decaying so much faster than the back option that he's buying, that 2-point vol difference is okay. Okay, he knows that if it was, say, -3, or it was even a bigger difference, that's too much to give up. If it was ever at 0, or a positive number, meaning he actually bought right? If he ended up getting a chance to end up buying that 11.5 in the back month, but he could sell the front month for 13.5, he'd load up the boat because he knows that he's got a great risk-reward trade. Put it on in a directional piece, and he's got a 50-50 chance. And I know some people say, well, it depends. I don't guess as well. I can't even guess 50-50. I'm terrible at that. But if he can end up guessing just at 50-50, if it moves in his favor, right? If it moves in his favor, what will end up happening, meaning if he puts it on above the money, the front month vol will end up coming down at a much faster rate than the back month vol. So therefore, what he sold shorts, okay, is basically going to end up, losing its value at a much more rapid pace than what he ended up buying. And because he bought them when the difference between the vols were already in his favor, when they come back into line, and let's say they average around 2.5, when they come back into line, and if the market bounces up, that difference in vols should come back into line. So he'll make money in both delta because it went up, and in terms of vega or theta if you want to take a look at it because it's decaying, but he'll make money on the volatility, because the volatility will come back more into line. Now what happens if it goes down? He's going to lose money on his vega. He's going to lose money on his delta, but his vega is already out of line. So he's lost most of the money. Well, he didn't lose it because he put it on at a good price. But the volatilities have already gotten out of line. So yeah, they might get out of line more, but they're not going to end up getting out of line even more in most cases than what they would end up coming back into place if they move back up. And again, it's the difference between the front month and the back month. And if for all of you who don't understand this whole volatility stuff and what ends up making the most sense, the greatest analogy I've ever heard about, in terms of a simple analogy that everybody can end up understanding about, when you're buying that back month volatility that decays at a much slower rate and you're selling the front month volatility and it ends up expiring a lot quicker. Basically, the analogy was he's buying green bananas and he's selling brown bananas. Right? The brown bananas are going to get thrown away. They're going to go to zero because they're going to be junk anyway. And the green bananas are going to turn into yellow and he can end up making a lot of money on them. That is the whole premise, of the calendars. And the key is, now once you understand the banana analogy, you have to end up knowing how much the brown, yellow, and green bananas are worth. And when you do this over and over and over for a decade, or more than a decade, the way Himanshu has, he's a really good pricer of bananas. So he'll know when to end up getting into, this option versus that option because of the pricing on it.
Yep. That was a good one, the banana ones.
If you could repeat, what did you roll? What was your thought process?
Why did I roll?
Yes.
Oh, I was still on the rock. Okay, I was going to show something else, but let's just stick to the rock and let's take care of all the questions. Yes, first of all, when you are trading the weeklies, there are two ways you can deal with it. You can say, okay, I made my 5, 7, 10% and I'm just going to get the hell out. That's one. That's a standard weekly. What this would be considered is more of a campaign weekly, where what happened today was that the price went all the way to 12.16, right? It hit my short strike, and therefore I said, and plus I had made money already, so I'm like, okay, now let me reduce my overall cost, and so I rolled it to the same strike, but further out by another 7 days. So now I'm 15 days away instead of 8 days away. But what also this will do is that when I was right over here, in the front week, my delta had already gone negative. If the price, if my calendar is below the current price, the delta will always be negative. And I do not like negative deltas with my calendars because I know that my vega will protect me in case there is an increase in vol. But if the market moves up and the vols decrease, then having a positive delta will help me. Right? So now when I was here, my delta was like minus 20 something. And when I rolled it to the next week, it went down to -8. I'm willing to keep it at -8 because, this is still early days, but if it goes back to, say, about -12, -13 on on Tuesday, Monday is a holiday, I believe, then I will do something else, maybe convert this whole thing into a double calendar so that my delta remains positive and my little ball here, which is the current price, always stays inside the middle of a tent. Whatever the tent looks like, this ball needs to be close to the middle.
Himanshu, could you roll back before you made the adjustment?
I'm not sure if I can do today's
Because
thing.
this is Thursday. Okay. Well, if you can't do it, here's what I would also say. Two things. Okay. There are two
Let
things.
me do this. Let me do this. This is equivalent to not having rolled. See, my delta is now -18.88. That's too much.
And what ends up happening as we get closer to expiration, his gamma is starting to go and get out of control. It's going to end up growing. It's going to end up increasing almost exponentially. As Dave Stewart always points out whenever we talk, I mean, it's increasing with the square root of time. Okay.
Ooh, that's a good idea. Somebody says do this. Ignore today's trade.
Oh, there you go. And then get those off. Ooh, look at that. Okay. So you guys remember where he was? His volatility, okay, was at 1.49. Okay. He cut his, his gamma was at 1.49. He cut it by more than 50%. Okay. Got his delta under control. Okay. And ended up, got his delta under control, number one. Number two, he got his gamma cut in more than half. And remember I told you there were 2 points? And here's why calendars are easier to manage than condors or butterflies. And with a single roll, he's totally repositioned his tent. You want
Not only that, and I cut down my margin.
Right? He's taken profits out of the trade, right? So by able to, I mean, there's three benefits. The first one is we end up talking about how easy it is to manage the Greeks. Okay, it's a lot more forgiving. Number two, by doing a roll, you can totally reposition your tent. For those of you who trade the M3 or any type of butterfly, and I love them too, don't get me wrong, but when we want to end up repositioning, we don't roll a single option. We take, 3 or 4 strikes off, and then we put on 3 or 4 new strikes. And when the market's moving around, that's a little bit difficult. It's a little bit harder to end up getting filled. So it's much easier to end up doing these rolls and repositioning. Okay. And then the other one that he ended up mentioning is that by doing the roll, he's collecting money, and he's locking in profits, and he's taking risk off the table. And, one of the things that I know that butterfly traders and things they talk about saying, well, once I collect a certain percentage, aren't you better to take the trade off? And the answer is statistically yes. Well, that's kind of already embedded into Himanshu's rolling strategy for his calendars. The last point I'll want to end up making, and Himanshu and I have had this conversation in detail many, many times, is that I see some people saying, well, I'm going to go and buy a 3-month option or a 6-month option. I'm going to sell weeklies against it. Here's the problem when you end up going too far apart. And you noticed everything he's always talked about: buy a monthly, sell a weekly. Buy the 2 month, sell the 1 month. Maybe buy the 4 month, sell the 3 month, or buy the 5 month, sell the 3 month or the 4 month. So he's always, one strike or a month away. He's usually pretty close. So what happens is that when it comes to that weighted vega, where weighted vega can really end up killing you, is if you're selling, let's say, the weekly or the 2 week or even the monthly, and you're buying a 6 month or a 9 month, if that moves against you and it ends up going down, that front month vol can end up skyrocketing compared to the back month, because the back months won't move very much. In our trading group, and also I think on the Monday market analysis, I showed on VIXCentral.com You know, and you can do this almost any day. I showed that if I end up taking a look at the current day, I think that the VIX was trading at something like 17. And if you go to the history, he chooses one of the worst days back in 2008 where the front month, okay, VIX option was trading in the upper 60s. Okay, so it went from like 17 up to, you know, 65, let's call it. Whereas the 9-month option went from like 21 to 27. Right? It moved, but nowhere close as much. So what happens is that when that front month in really horrible moves, where it can end up exploding in value and the back month barely moves, when you're doing 6-month or 12-month differences, you don't have any Vega protection. Your Vega risk is enormous in something like that. Okay, not only that, but you don't have the delta protection, because what happens if it starts to run down, okay, that front month delta is going to go to -1 immediately, whereas the back one, you started it at 50, maybe it moves up to 60, okay, 62. So you're going to be getting double whammies. You're going to be getting killed on the Vega. You're going to getting killed on the, and here's the biggest thing. It cost you a ton more money because you had to pay for all of that time premium, so you have a lot more risk on the table. So the fact that everything Himanshu has showed you, and it's kind of built into his strategy to do calendars but not do them too far apart, and try to end up getting the optimal, how do I collect as much money with as little risk as possible, and then doing it for the last decade, I think makes the trades very, very strong. And as I'm talking, I'm seeing questions go by. I'm sorry, I didn't even
Yeah, I'm looking at some of the questions. Rahul is talking about what is CCI. We'll talk about that later. Let's just finish talking about the calendars. Jack is asking, when do you use a single calendar versus a double calendar? I always start with a single, and then when I adjust, my first adjustment will convert a single into a double. And occasionally, if the walls are real low, a double into a triple, and then I keep it at a triple and make sure that the current price is usually where the center calendar is centered. So you keep on moving the calendars up and down. That's one of my perpetual IBM calendars, which also we can talk about later if you want. But to answer your question in simplest form, I always start with a single. And Vijay is saying one advantage of taking the trade off after the profit is that you are out of the market within 3 or 4 days. Yes, that is correct. And usually when I trade the weeklies, so I have a weekly calendar where I just say, okay, I won my 5% and I'm out, and that's it. The other weekly calendars that I trade are what are called weekly campaign calendars, where I keep on rolling and rolling and rolling until I reach a stage where my margin literally goes down to 0. At which point I am free and clear. It's a free trade. There is no way I can lose anymore. And then if the underlying makes a big move in my direction, then that's pure gravy. Make sense, Vijay?
It did to me. And to
Okay.
VJ.
All right, and again, I don't trade only the RUT and the big indices as well. Let me just give you a couple of ongoing examples that I currently have in my portfolio. And of course, when I'm trading an underlying that I haven't traded really too much, I try to keep my total debit very low. Like for example, I was willing to lose $191, okay, in this particular case. But instead, I ended up making 103, which is 96.26% of the current margin. That's because I already rolled once. But my original margin was $191, and out of which I have made close to 53.9%. And this is why I was saying that once you really know your technicals, you can put that expectancy even more so on your side, because, you know, literally 8 times out of 10, you probably will, the underlying will move in the direction that you said it will. But the good part about trading is that you have to assume that you are going to be wrong to start out from that mind frame, so to speak. You just say, okay, I'm going to lose $170, right? This is TCK. I don't even know what TCK is, okay? The skew was right. I'm like, all right, let me check it out. The technicals are telling me that it's going to move up. So I put this trade on, and I was willing to risk $170, and I made $265. And I still have at least one more. Well, no, we have March, and then I have April. This only has monthly options. So I still have 2 more rolls left. So God knows how much this will end up at the very beginning, but I don't care. As long as my current margin goes down to 0, then I know that I cannot lose. Even if the stock then goes down to 0 for whatever reason. And this is, of course, only a $14 stock, so it's not like I do too many of these, too much. In fact, just the other day, after all this oil stuff that is happening, so Tesoro, I believe it is called Tesoro, TSO, is a stock that, so I placed this trade on. Today, the trade, it goes down by 6.72%. It goes down by almost $6, and $81 stock, $86 stock goes down to 81. Total move since I put on my calendar is minus 1.09 standard deviation. And I have the Feb and the March 85 calls. Where is 85? And this actually does have the weeklies. See, in 3 days, I'm up by 7.69%. I was willing to lose 429%. In fact, tomorrow or probably not tomorrow, hold on. Today's Thursday or Friday?
Thursday.
Today's Thursday. So yeah, tomorrow I will probably add another calendar down here and convert this into a double calendar. Now, as I said before, one of the things I said was that you can morph this thing into something else. So what I can also do is I can buy back this 3, but when I go to the next week, instead of 85, I can go to 84. And now I have a diagonal instead of a calendar, and I just brought my delta from 48 down to 6. I still want my delta positive because my Vega is positive, and that'll help me. So my Vega will help me if the market moves down. My delta will help me. I want my delta to help me if the market moves up. And of course, I want my theta to help me at all times. But you will notice one thing. In stocks, you will find that the gamma, look at the gamma, it's minus 7.52 on just a 3 lot. That is so one of the things that you really, really have to pay attention to when you are trading calendars is gamma. Because this will get your delta, literally your delta will double if this thing moves down by another like $2. And then you will really start getting hurt badly. So, any more? Okay, somebody else has a question. Yeah, it went down the same percentage as crude oil. Yes, big lots. Yeah, that's right. Not too many people look at that stock. It used to do very well once upon a time. It's gone down the drain now, but every now and then, using calendars, you can, make 50, 60, 100% on your slightly directional calls. Jack is asking, when you add a second calendar, do you still want an overall positive delta? Yes. So one of the things that I might do, like right now my break even is at 80.88, I may actually go to something like say 78 and say add minus 3 here and go all the way to March. Am I in, where's March? Wow, March is way up there. Okay, 78 again, plus 3. No, plus 3. Oh, there is no 78 here at all. Okay, so I'll go to 77.5. I'll have a diagonal down below and a calendar up above. And my delta now goes from 48 to 7. Literally, I cut it by 2/3.
And the gamma in half again.
No, the gamma will increase because I'm doubling my number of contracts. So the gamma actually went double. But my
Okay.
theta also went
But
down.
it stayed the same per contract, if
Correct.
you will.
Right. So Steve is asking, how about put characters, pros and cons? Actually, they are identical to call calendars, but if I want to be slightly bearish, if I think something really bad is going to happen, or if the technicals actually show me that now the underlying is going to go down slightly before coming back up, then I will have a slightly out of the money put calendar, in which case I will not only have a positive vega, a positive theta, but I will have a negative delta. So put calendars actually work better if you position them properly, because now all three of the four Greeks are helping you. Yeah. Okay. Good.
Yeah. One of the quick comments about put calendars is, especially on the indexes, because they're cash settled and the dividends are rolled in. You may think, oh, look at this, okay, I have an advantage, okay, on the put calendar versus the call calendar or vice versa, and I can tell you it's minuscule. And the reason why it's minuscule is that today with the amount of high-frequency trading and options models that are out there, if there was any edge, it would just be pounded until it was taken out, okay? So I'm not saying that it's absolutely perfect, but, it's not going to be more than a penny or two at a line, okay? The market, at least to get filled, if the markets are a little bit wider, you may see a big price difference, but try to get filled, okay? That's the difference.
That is true, yes.
Okay. The other thing I want to end up kind of just mentioning on this, okay, I would end up saying that Himanshu's been trading calendars more than the vast majority of us on this call. And did you see the size that he put on when it was an item that he didn't know as well? They were 1 and 2 lots. Okay. You want to learn with 1 and 2 lots, that's fine. Did you also hear what he ended up saying? He was willing to end up losing the entire amount of the calendar. So when you look at the percentage gains and things, don't think that, oh, look at this. Well, if I take, half of my net worth and I put it on this weekly calendar, if you're going to end up, Himanshu and I were joking, if you're going to end up doing that, you probably have just as good a chance to go to Las Vegas and bet on red. Okay, because yes, it will end up working if you end up working the craft and doing it, but it's not going to change the odds. You have an advantage, a slight advantage on all of them. So the key is good money management and proper amount of risk on these trades, and you just keep doing that over and over and over again. And what Himanshu and I, we always talked about was that when you got really comfortable and really good at a specific trade, you can end up rising up your size to a very reasonable amount to end up making money. But you don't do that until after you've developed the skill.
And even now, after having traded calendars for this long, when I'm trading the big indices, I rarely have a trade where my debit is more than 20K.
Yeah, but by the way, if you don't know Dave Stewart, he's like the chief heckler. Okay, he said, "Damn, he was going to bet on black." Okay,
no problem.
Okay.
Hey, Himanshu, there's a good question. Can you show a trade or maybe talk about one where you couldn't save it with like a big price movement? Like, did you have anything going on in the flash crash or some of these big moves we've had lately? How does that affect your calendar trading?
Yeah, certainly. In fact, I had a trade last year in Celgene where I lost about 50. Well, I'll show you the trade. Okay, here is the trade. It begins. Okay, it started out as a vertical because I was under the impression, based on my technical, that it is going to go further down. It actually did. So let me go to the next adjustment here. Okay, so I did make some money. I took one off, and then I decided to be cute, as I tend to do every now and then. Okay, damn it, this wasn't the calendar that I was looking at. Okay, it moved up big time. What did I do? Okay, well, let me just show you some. For example, let's say we are in a trade like this, right? Let's say we are somewhere on this day, which is, or let's say, remember, you want to put on a trade when the walls are low. And usually walls are low when the market or the underlying has just moved up a little, correct? So for example, on a day like this, you would think that the walls are really low, but a couple of days like this, you know that the walls are also now much lower than what they were on over here. So you would put a trade on and then it would drop like a rock. Now, in a calendar, you will realize that if you are actually sitting in front of your machine and you have your alerts in place, most of the times you still will be able to salvage something and walk away with a break even or like -1 or -2% kind of thing. But just to show you something here, on December 20th, oh, this is 2013? Yeah, December 2013. You know what, let me look at the Celgene, because, or I don't know if any of you happen to know a time. Well, yeah, look, let's look at October. When we had this really, really large moves in just about everything. I believe Jim said that it was the second largest, two of the largest one-day VIX moves since.
Yeah, there was a Goldman Sachs report that I shared with my covered call class. The fourth quarter had 2 of the 10 largest weekly VIX moves in its history since it was introduced in January 1990. 2 of the 10 largest weekly moves. And what made it a challenge was that according to Goldman Sachs correlation model, how much the VIX moves up when the S&P moves down and vice versa, that the VIX jumped an extra 4 points, which from its starting point was over 22% bigger move, in a relative basis than it should have. So you will get these enormous displacements at times.
Oh, yes. And in fact, in October, again in October, I believe, October was one, and then December was another one, where the SPX went from a high of 2079 all the way down to 1973, which is slightly more than 100 points within like 5 days. So if we were to, and that particular time began on the 8th of December, so let's suppose that we happen to be let's say in the second last week of November, right before Thanksgiving. And by the way, if you look at the market, see, the market has kept on going up. So you would think the walls are real low. Look at this. The walls are like in their 9s and 10s. So if you had a regular trade here where you said, okay, I think it's going to continue to go up. The price is at 2065. Or 66, I do not like the 5, so I'll go to, say, 2080. Slightly above, because remember, I want my deltas to be positive. And I put on a trade here. Let's say we say -5. And we go to January. January here, 2080, so plus. So this is a normal trade. The VIX is very low. This is 1022. Oh, hold on. Let's make sure that the skew is okay. That is 1022, and over here we have 927. Okay, so it is less than greater than -2. So this is a trade where it looks like this. We want it to go up slightly, but instead, over the next few days, it drops like a rock, right? So let's see what happens here. So I call this test case. In this case, and this is specifically for you, well, all of you, but I believe it was Rahul who asked what would happen. So let's go to the end of the day here. And nothing much has happened. It is still where it was before. Next day. Oh, come on. It's slowing down on me again. 2.73% day 1. Day 2. Then day 3, 4, 5, and 6 are holidays. This is right before Thanksgiving. So we are at 5%. Next day was Thanksgiving. Friday was open, but I don't believe anything much happened on Friday. It was half day, I believe, if I'm not mistaken.
Yes.
And, oh, it did come down a little bit. Okay. So now we are at 7.29%. So let's go to Monday now. Accessing, please wait. Okay. Hurry up. Okay. It moved down by 1.24 standard deviation move. It is, I actually would have adjusted somewhere over here, but just assume that I'm looking at the whole thing, you know, literally at around 3:30 p.m., which is what I normally do.
Okay. Himanshu, I want to make a comment about when you end up, did you keep this trade on, by the way, through the 8th and 9th and 10th, or you out of it by then?
I was out of it by then, but I want to show Rahul, because we still have 18 more days, and how we, so now I'm already at my adjustment point. I'm at 2080, the current price is at close to 2060, so it's 20 points. So I'll go to say 2040, and I will, so what I will do is I will take 2 off from here, because I don't want to add to the overall debit. And I will go to 2040, and I will add 2. And minus. So I brought my delta down by more than half. I got my gamma down just slightly. I increased my theta, and my vega is more or less the same. But as you can see, the green line now, the downward slope is a little bit more flat. But my delta is still positive, as you can see. So next day, next day it moved up. Let me look here. Okay, next day it moved up. The day after that,
The fun really starts on the 8th. That's when the fun starts.
yes, that's, and actually not just the 8th, and on the 10th, but I'll show you. Okay, so now our delta is negative. I'm not sure which way it's going to go. It is at the top of the Bollinger Band, so I'm going to give it one more day. Let's see what happens. God, this is really taking a lot. Okay, now it moved down big time. But this is only the 4th. I am still up by 3.6%. Let's move forward to the 5th. My delta is positive, barely. You can say I'm more or less delta neutral. Next day it moved up. Look, I'm at 9.48%. My delta is now negative. I'm not sure which way it's going to go. So what I would normally do, and this is exactly what I did, I'm going to take one calendar off. That way I am protecting my profits a little bit, along with making everything even. so that in case I have to adjust, I don't have to think. By the way, I forgot to mention some of my aphorisms as I normally do. One of them is that laziness is a virtue. And the other is that you should never ever believe everything that you think, as you will soon find out. So here, when we entered the trade, we were like, oh my God, this is real low wall environment. This is the perfect time to get in. And now things are looking a little dicey, right? Look, it meant another 1.37 standard deviation move. So now the next day, which is Tuesday, we are still up, by the way, okay? And we are not even making any adjustments in the middle of the day. I'm looking at the damn thing at 3:25 p.m. The only problem is that in real life, when you do make an adjustment, you may not get the fill that you get here. Now, in this case, it was a day where anybody who knows even a little bit about candlesticks will say that tomorrow is going to be an up day. Literally. Because, you know, this was a big red bar and the whole bar just got removed and it almost turned green. So now...
And we bounced above, okay, the EMA support line that you had for a while.
Exactly. All right. And it also came down and touched the lower Bollinger Band. So I literally was almost ready to say, tomorrow this damn thing is going to take off to the moon. So I wanted my delta positive, right? So my deltas are positive and I'm like, all right, everything is cool. So now the next day is when the carnage begins. This was one of those 2 days where the VIX moved big time. Okay, so I lost how much? Literally, I lost from 13.78% down to 10.96%. Right? This is the day when you would have said, oh my God. But now, on this day, my technicals are telling me 2 things, okay? One thing is telling me that this could continue down. And the other thing, because remember, there are tons and tons of technical indicators, and when you use more than 2 or 3 at a time, you will get conflicting conclusions. So one thing was telling me that this is really going to go down, and the other thing is telling me that, hey, it is at the end, it just touched the Bollinger Band, so it's got to take off again. But of course, when you see this, you say, well, maybe it won't. So I have to be careful now. My delta is still positive, but look where the price is. The price is below my second calendar. It went below my second calendar. My second calendar was at 240, and this price is at 20.2033. At this point in time, according to my rules, when the price touches one of the calendars, I take the other calendar off.
Okay, Himanshu, I want to make a comment here for some people. So some of the folks who are watching this might say, you know, with the vols moving the way it did, you know, why didn't he end up losing more money? I don't end up understanding this. What ends up happening, and when we talk about the skew within a single month, okay, the put skew, meaning that the further you go below the money, okay, the higher the skews are. As you go above the money, usually the IVs get lower and lower. So what happens is that when you look at them on a chart, they go from upper left to lower right, meaning that the further you strike price, you look down in any given month, the higher the implied volatility, so the higher the cost. So what ends up happening is that when you have a drop in price, think about where your strike was. And if the skew curve doesn't move at all, but the price moves down 2%, what just ended up happening is that you moved further up on the skew curve. So even though the entire implied volatility is going higher, okay, since you moved, okay, basically in a relative position to the right of where the skew, because the whole price ends up moving. So what ends up happening is that the increase in your implied volatility does not move up as much as the VIX might. Now that happens a lot more, okay, in the front month, okay, where he's short. It happens less in the second month or third month where he's long. So what happens is that that difference in implied volatility is helping to offset some of the loss because of the way he structured this trade. Okay, very, very important.
That is one thing, and if you don't understand all those things, remember one thing, that a positive Vega will always help your calendar. So if the vols go up as they did here, you got some benefit because of a positive Vega. Essentially, in a nutshell, in a very simplified form, that in case you don't understand what Jim just said, then just remember that a positive Vega will always help you when the market drops like a rock and the VIX shoots up. Of course, it is not, how exactly it helps is a much deeper subject that we will get in maybe 3-4 months down the line. But at this point in time, because I'm at one of my strikes, I take off the other strike, which is a standard, a completely, totally standard adjustment criteria for calendars. So now I reduced my total max margin, which was 6,453 down to 2794. So now, and plus as it is, I have made some money already, so I could get the hell out. But at this point in time, I still want my delta positive because, you know, it's at the lower Bollinger Band, so maybe it'll go up, which of course it doesn't, because, you know, I was too busy thinking that, no, I'm not thinking, I was too busy believing everything that I thought. But strangely enough, the next day is a green bar, as you will notice on this day. See, it went up. Look what happened. It actually went up quite a bit, but then came back down. See, this was, this in the last half an hour, which is not showing here, it actually, this green bar was more or less reduced considerably. But at this point in time, we are still okay. My delta is -2, which is more or less, you can call it, you know, delta neutral at this point in time. So now I'm waiting, right? I'm like, okay, let's see what happens next day. Maybe it'll go back up because it is at the bottom of the Bollinger Band. This is what I'm thinking. I still have not reached my adjustment point for the single calendar, which is midway between the strike and my break-even. And my break-even is at 1984. And my strike is at 2040 to 1984, let's say 1980, so that's 60 points. So when it goes down to 2010, I will actually adjust. So far it hasn't been there, but it is getting there. So next day, if we move further, it actually will probably go down way, okay, look, it went all the way to 1990. But in the middle of the day, I don't know when, let's say at some point in time when it reached 2010, that is when I would have adjusted. But, and this is what's really going to happen in real life. In real life, chances of you getting one calendar off and putting another calendar further down, for you to get the right fills and everything, not going to happen. See, 2004, it's already gone down below 2010, and it's 10:55 in the morning. Let's see, okay, 2015, let's say around 2010. And if you have, okay, it just went straight down to 2005. At this point in time, this is what you would do. Buy one back. And suddenly your delta goes negative. And now you are golden. Now, normally in real life, what will happen is that as soon as your delta is significantly negative, the market will turn around and go the other way. Literally, that's what will happen most of the times. In this particular case, it didn't happen. We are all the way down to 1989. And now I'm saying, okay, maybe the next day we may have some way, shape, and form. In some way, shape, or form, we might be able to convert the whole thing into a real calendar again. Okay, now it's going down even more. At this point in time, what would you do? Anybody? That was a real question. Rahul got it right. At this point in time, you just get the hell out. But had you not done this trade, the trade where we actually said, take one off, assume that you could not take it off, okay? Come on, I'm going back to the previous adjustment. Okay, let me go here and just remove the trade that we did and say, suppose we could not do this at all. In which case, by the end of the day, you would have been hurting real bad. You're down to 4%, and the day after, when it sank all the way down to 1970 something, see, now your delta is positive because your calendar is above the current price, and you would have lost money. At this point in time, what would you do? You can either get out or say, we are 3 days from expiration, let's roll this over and collect $3. So we do. Our delta is still positive. So if it goes up the next day, we will make some money. Oh God, it moved up by 39 points? Holy smoke.
It was unbelievable how much.
And look what happened.
This is
we are now back up to 25
forward another day.
So again,
click
remember
one more day.
That, well, we can, if we go one more day, I believe it goes, then it just keeps on going up for a little while now, I think.
It starts to accelerate going higher.
And see, now we are losing, our Vega is actually hurting us, but our delta was positive, so we are actually up by 15% on our original margin and 41% on our current margin. Like most income trades, you will get hurt more on the call side than on the put side. Somehow income trades always work well on the put side, every one of them. So maybe this was not a good example, but if we now were to not do anything and leave it like this, then we will certainly start losing money big time. Yeah. But again, as you could see, most of the times I am adjusting just once a day.
Okay. ML,
sometimes on some, sorry?
ML asked the question about because the front month, okay, volatility moves more than the second month, okay, does the Vega still help? If you remember on his first slide, ML, we talked about the fact that Himanshu trades, it's a positive weighted Vega. And what weighted Vega means is to take into consideration the difference of how quickly one option moves at one expiration versus another. So the answer is yes, usually, but not always. So that's why understanding, where the trade is, meaning relative to the current price and what your deltas are, above the money, below the money, and where the implied volatilities are of the two, is the skill, that needs to be developed to end up trading calendars on a long-term basis. Now, it's important to understand why, but the bottom line, as Himanshu will tell you, is that, no matter what the volatilities are, it comes down to what the price is of the calendar, or of the difference between the two strikes that you have if it's in a diagonal. And it's that difference in price and knowing how that price will end up expanding or contracting in different market environments. That's at the bottom line of how you end up making money at this.
That's true, and usually you will find a lot of people who start out with calendars, they end up getting very frustrated because they're like, At least most of my folks in Trading Group 7, they are like, well, I don't know. Every time I go with every time you talk about calendars, I'm like, starting next week, I'm going to do calendars. And then 2 weeks later, I'm like, this sucks. I can't seem to make money at all.
Himanshu, we've been going now, about an hour and 20 minutes. So we've been going a little bit long. So what I'd like to end up doing is finish what you're going through, and then I'd like to tell people, because obviously, we haven't lost anybody during this time. Everybody stayed on the call. We're going to end up doing some follow-up stuff, but I wanted you to finish up this one, and then we'll kind of wrap up.
Okay, actually, this was it. I mean, even when we did a trade where the market moved big time, we still ended up, even as a worst case scenario, we would have lost 4.8% ROI, which is pretty reasonable because usually 20% of the debit is the max loss that I have. And usually on my regular calendars, when I make my 20%, I'm actually out of 80% of my contracts and then leave the last 2 on and keep on adjusting and essentially learning, because this is something that just keeps on going all the time. So again, and as Rahul is saying, it happens to me every time I saw you in the uncertain days. Okay, yes. That's very true, and that is why most people don't trade calendars. And I am always very frustrated because I can't seem to get across to the people that calendars are a trade where not only can they really make you a goodish amount of money, especially when the market is dropping like a rock, but even if you have other trades on, having a couple of trades like this sitting there underneath the market will help your overall portfolio as well. So in a way, you can use this as a hedge by having a negative delta trade and just having it sit there and keep on making money as you keep on rolling, so you still make money. And if the market does drop like a rock, you end up making even more money.
Okay.
So Rahul actually also wants for me to talk to him about Woody CCI, but as Jim just said, we are already 20 minutes over. Well, so why don't we have some other time we can set for specific technical analysis of Woody CCI over the next couple of weeks?
But what we'll end up doing, Rahul, and he wasn't the first one to ask about that, we'll commit, Himanshu will come on one of the Monday market analysis that we do, okay? Next Monday we're not going to do, it's a holiday, and I'm traveling on Tuesday. But the following week, if you would come on, okay, a week from Monday, we'll go over when we do the technical analysis, we'll dedicate that session to Woody CCI. Okay?
Okay, yeah, we can do that. So not this coming Monday because it's a holiday, but the Monday after that.
Monday after.
So on the 23rd of February at 4:30, Rahul, I will spend about half an hour talking about Woody CCI and the specific strategies to go long and short using only Woody CCI and nothing else.
Okay, and if you go back to your presentation screen, what we're going to be doing is that we're going to end up having, because a lot of people have asked about Himanshu's calendar, how he ends up trading them. What we're going to end up doing is that we're going to have a kickoff session where for anybody who wants to end up following, okay, Himanshu's 3 types of calendars, right? His shorter term weekly ones, the regular income ones, and then what he ends up calling his wealth calendars, which are the ones that, quite frankly, the ones that I like the most, because when you go out that far, you're spending such little money for the calendar. So for the chance of them to end up being in the zone at any point during the trades actually do give you, I think, the greatest chance to end up growing your wealth at the lowest risk. We're going to end up doing that. Now, we're going to end up having a kickoff session. Have we finalized the date for that? Are we going to do that on the 24th?
Yes.
Okay. So on the 24th, okay, and you'll see this go up on the calendar within the next day or two, Himanshu's going to end up doing a kickoff session. He's going to go through his trades, what he ends up doing, how you can end up following them, and then there'll end up being, a free 15-day period. And for those of you that want to end up following it and have a trade alert service where he'll send out trade alerts, for every single trade he's doing, he'll end up doing that. In addition to that, he'll end up doing weekly, okay, very similar to the way Amy Meisner's trade service went. He'll end up doing weekly videos, and then what he'll do is that he'll review all of the trades in a WebEx on a monthly basis, and there'll be interactive places. There'll be a page where you'll be able to end up asking questions, and so all of that will be set up. Tom, from an infrastructure point of view, anything else that would be important to end up mentioning?
I don't think so. It's going to be similar to what Amy has. Himanshu will be able to send out signals via email and SMS, upload trade documents. Subscribers will get access to the recordings. So, but we're also going to do a 15-day free trial. So I think it'll be good. It'll be close to what Amy's doing as far as logistics, but obviously with Himanshu's flair and twist on it.
Which is very entertaining, at least I find it. Himanshu, any words you just want to end up mentioning about the service and the kickoff? And we're really excited to end up having it, and we thank you very much for offering this to our Capital Discussion members.
Not really much. The reason, one of the reasons, as Rahul knows, that calendars, for some strange reason, most people can't really seem to grasp them well. I do not know why, because strangely enough, or maybe I'm just, the opposite of most people. So calendars, I understand. I have difficulties understanding the entries and all those other things, which is why I need to sit with Ray one of these days and understand, because he's a master of that thing. So this way, not only I'm trading, I'm making my money with all these things, and if you guys can also learn while you are earning some money, then it's great for all concerned parties. Good for you guys, good for me, good for all our potential students and prospective customers. And the best part is that once you know how to do this, then you can go out there and do it on your own.
Right. Now, what we're also excited about is that, we're going to start with the trade alert service, and you'll follow, what he's actually doing. But Himanshu's also in the process of putting together an actual calendar class where he'll actually go through, how the 3 different calendars are, what he looks for, how he ends up building them, when to get in, when to end up getting out, actually going through this. And what we'll end up doing is that once the class is completed, that will end up also being offered to all members. Okay. And so, Tom, do you want to end up closing it up? Anything else?
I think that should do it. Thanks, Himanshu. I really enjoyed it, and thanks, everyone, for sticking with us to the end. Hope you got something useful out of it today.
Somebody asked a question. Great. Are you starting this? Okay. This is what
the answer is yes, it'll be similar. We'll go through all of that in the kickoff. Okay, we'll go through everything about the service and how it'll end up working during the kickoff meeting, and it'll be posted, and an email will be sent out to everybody, so everybody will end up seeing that. So, everyone, thank you very, very much. We really appreciate you attending, and we'll talk to you soon.
Everyone,
okay, thanks, everybody. Hope you had a good time.
So, thanks again. Bye.
Okay, bye.